Good day, everyone, and welcome to another episode of Friar Financial's Financial Forum. Today, Wednesday, June 10th, stocks under pressure. They finally wilted after 8 or 9 weeks of rising, which leads us into greed versus caution and big SpaceX IPO that we'll briefly talk about. And two, is that time of year for mid-year portfolio reviews. So we'll talk a little bit about why it's important for you to take a look, a breather, especially this year with what's been going on, and take a little bit of a look at your mid-year portfolio review. So after the break, we will come right back with Markets in Motion. All right, so let's get started. Markets in Motion this week. Get this screen up here. Y'all bear with me. I have like 3 screens going at the moment. All right, the S&P 500. Let's do its recap for the week. As you can see, we did not end on a good note. That's why we're saying stocks are a little bit under pressure here this week. U.S. market stumbled last week as investors reacted to the rising oil prices and strong jobs data that revived fears of renewed inflation. So you can kind of see from the chart below, the Dow Jones was actually down 0.32%. The S&P was down 2.59%. NASDAQ was down 4.68%. And the developed international markets were also down 1.41%. So let's kind of look at what took place Monday, Tuesday. The markets opened off that June momentum. All 3 major indexes hit new highs on Monday and Tuesday, as you can see there. The S&P notched its first close of above 7,600, and the Dow gained nearly 0.5%. Midweek, though, those rising oil prices swept right in. Of course, that's still tied to what we've been talking about since February, I think the war started, tied to those Middle East tensions. By Wednesday, the S&P and the Dow both had given back everything they had gained early in the week. And then, of course, by Friday, we see that drop there, sell off. The jobs data came out stronger than expected, but reignited concerns that the Fed may need to keep rates higher for longer. So that's kind of the bad news that the markets reacted to there. So the S&P was down more than 2.5% on that day. NASDAQ down more than 4% that day alone. So again, strong labor data is good for the economy, but bad for our rate cut hopes. All right, Jeff,
Yeah.
what we got going on this week?
Yeah. And then speaking of data, we got some key economic data to watch this week. So on Tuesday, we got the NFIBs. This is Small Business Association, Small Business Optimism, trade balance, and then existing home sales also coming out this week. Wholesale inventories also on Tuesday. Then Wednesday, we got the CPI. That's the headline inflation along with the federal budget. On Thursday, we got weekly jobless claims as usual. And then we got the PPI, so our producer inflation. And then on Friday, we got our consumer sentiment. And then we kind of going into our job market. The labor market is still hot. So non-farm payrolls, they added about 172,000 jobs, and that more than doubled expectations of what we're looking to see. Hiring rebounded lately as employers resumed activity after last year's trade and budget uncertainties. Now employment, that stays steady at 4.3%. Then the ADP private sector report echoed the strength in the federal data that we saw. So some good things, some bad things per usual, but some good things happening. And then as we get into earnings, just a couple this week, but a couple big ones. Wednesday, we got Oracle, and then Thursday, we got Adobe. And that'll wrap up kind of our markets in motion. And then after a quick little break, we'll come back with finance and focus as usual. All right, welcome back, everybody. Now we'll get started with finance and focus, and I'll get it started off with kind of some Federal Reserve talk and then the interest rate landscape. So the Fed pause, there's a narrative around that, and markets increasingly price and the prolonged pause with rate cuts pushed further out. I know markets touched a little bit of that earlier. Then core inflation continues to cool, but services inflation, so inflation in the services industry remains sticky. Economic data digestion Labor market remains strong, but shows early signs of softening, which is good. So then, as we get into corporate earnings and business trends, companies are beating on earnings, but guiding cautiously on margins. As we get into earnings seasons, that's a thing we're seeing across the landscape. Now we've touched on the last couple of weeks that AI investment boom, and firms are continuing to allocate capital towards automation, cloud, and AI infrastructure. So still a lot of boom in the AI industry, business as usual there. And then as we get into consumer spending, it's still healthy, but it's shifting toward essentials and experiences. And then profit margins for a lot of companies are stabilizing after several quarters of compression, especially coming from the tariffs. So that leads us into key financial news stories this week. Tech leadership. So keeping with AI-driven companies continue to dominate market narratives. Energy markets. So we got oil prices fluctuating still with the geopolitical tensions, and then OPEC plus production signals, and then getting last into our housing market. Mortgage rates remain the same. Inventory remains tight, but buyers are facing some affordability challenges, as we all know. And that comes from the rates being high and the inventory being tight. So it's still hard to get a house right now. I'm down let markets pick us up from there.
Yeah, good point, Jeffrey. I know there's still some talk about those big people, such as around here you hear Mark Spain, and them
Hmm.
still buying up that inventory. It's making it really tough on people to purchase a home. They're keeping those prices quite high.
Yep.
All right, so
And
investor
especially in a high
sentiment,
rate landscape
yeah,
too, is tough.
high rates too. Yeah, exactly. Yeah,
Yeah.
it's a double whammy there. All right,
Hmm.
let's see. So this week, investor sentiment and some of the behavioral themes. So we mentioned on the top, greed versus caution. So investors are balancing this enthusiasm for AI with concerns about the valuations. We'll get into that a little bit more. So a lot of cash is still sitting on the sidelines. High yields keep investors hesitant to fully rent their equities. That shows, I mean, we've got that cash account at Ultras paying 3.2%. So we got a bunch of people just
Hmm.
sitting right there taking their 3.2% and they're happy.
Hmm.
But the markets are now shifting. So people are increasingly rewarding fundamentals versus hype. So people are steadily coming back to wait a minute. We got to look at the technicals versus being so speculative here. And so, from a long term perspective, reinforce that discipline, that diversification and planning over prediction. So, discipline, diversification, planning versus prediction, which is what we're talking about with SpaceX here in a minute. And then borrowing costs, as Jeffrey just mentioned, remain quite high. Cash yields stay attractive and duration decisions matter. So if you're in those bonds, you got to have those shorter durations so those
Hmm.
prices don't fluctuate as much. So, what are your practical takeaways from all this? Stay allocated. Market leadership rotates quickly. Missing the best days hurts long-term returns. So, stay in the market. Revisit your risk tolerance. Ensure that a portfolio still matches your goals in this higher rate world, and focus on what you can control, which we've talked about: savings rate, tax planning, and discipline rebalancing drive those outcomes. But just a little bit on that SpaceX piece. So, Jeff and I were talking about before we came on. So, I reached out to our money managers that we kind of bounce things off of, and as they said, a couple things. It's so speculative, you just don't know which way it's going to go right now. And also, eventually, you're going to end up with SpaceX because
Hmm.
it's going to be in those index funds. It's going to be in that Spider S&P 500 at some point. So you're going to have some of it, whether you want it or not. So maybe no rush to go buy it because eventually you will have it. So anything you
Hmm.
want to add there, Jeff, on that SpaceX? Any thoughts from that
No,
the younger generation?
no, not on my end. I don't think so. Like you said, we're gonna get it regardless. So it's gonna be in all those funds. But right now, it's kind of wait and see what it's gonna look like when it drops. So
Yeah, yeah. It's kind of like the crypto conversation was.
exactly.
A lot of people want it, but they're like, I just don't want to miss the boat. So
Hmm.
a few
Which is
dollars to throw at.
understandable, but you also got to understand the risk that comes with that too, because the boat can go either way. So,
Yeah, yeah. So if you got a few dollars to throw at it, that
hmm,
you could throw out the window. Yep, go for it. So
yeah.
all right. Well, that'll wrap up Finance in Focus. And then we're going to be back with a dynamic session on mid-year portfolio reviews. So stay tuned.
All right. Welcome back, everyone, to another Wealth Wisdom Workshop. Today, we're talking about something that sneaks up on all of us, and that's the mid-year portfolio review. Exactly, and the halfway point is the perfect moment to pause, breathe, and check in, and not just with your portfolio, but with your emotions.
Exactly. So,
Hmm.
hey, Jefferson, first thing is like, how are you feeling out there? So let's start. Let's just take a gut check. Ask yourself, how has the market's year to date performance made you feel? When you saw the stock market drop on the evening news, were you calm or did your stomach twist? When you heard the word tariff, did it make you cringe? If a friend were to casually ask you, how's your portfolio doing? Did you feel a mini panic attack bubbling up? Or maybe you had a short term cash need and ended up selling investments while the market was down. Or you used a credit card to cover bills because volatility threw off your budget. These reactions matter. And one of the things we deal with is the psychology of money as well. But these are signals and they tell us whether your portfolio is aligned with your true risk tolerance and your real life cash flow needs.
hmm Because it's one thing to check a box on a risk questionnaire, as we all done, but it's another thing to live through volatility required to earn long-term returns. Your emotional responses reveal whether your portfolio still reflects who you are as an investor. We haven't had a major economic slowdown since the Great Recession of 2007 to 2009, and most market corrections since then haven't been followed by quick recoveries. This environment made it easy for investors to drift into overweighting stocks and underweighting bonds or cash. But now, volatility is back, to say the least, and it's exposing mismatches between risk tolerance and reality. And if you're feeling anxious, reactive, or financially strained, it may be a sign that your portfolio needs some recalibration.
Yeah, remember your portfolio should really support your life and it shouldn't stress you
hmm
out. So again, this is where we do this mid-year reassessment. We're in the midst of calling every client, sitting them down, going through it, because mid-year is the perfect time to reassess. So sit down with your advisor, or if you are your advisor, sit down with yourself and complete a new risk tolerance questionnaire. Compare it to your old one. Has anything changed? Has your comfort level shifted? Has your life changed? Then take a fresh look at your asset mix. Next, review your cash needs for the next 12 to 24 months. If you know you'll need money for home repairs, tuition, medical expenses, travel, major purchases, set that cash aside in as you all have learned, a high yield savings account. Few things can derail a fast financial plan faster than being forced to sell investments when prices are low.
hmm That's big. And now let's talk taxes, specifically tax loss harvesting. Even though markets mostly recovered year to date, many individuals' positions are still down, and that creates a window of opportunity. Tax loss harvesting means selling investments at a loss to offset capital gains or reduce ordinary income, and we can do that up to $3,000 per year for our tax loss. Just remember the wash sale rule. You can't buy a substantially identical investment within 30 days. This keeps your risk return portfolio aligned with while capturing this tax benefit still, which is important. So I'll keep that type of stuff in mind.
Yeah, so as Jeff's saying, during any year, take the S&P 500, all 500 stocks did not go up. So
Exactly.
So there's always the opportunity to reposition your portfolio. Maybe you've got capital dividends kicking off in a taxable account, and you're like, I don't want those. Take a second to see if you can reposition it. So as we hit this midpoint of the year, it's worth asking yourself, did your portfolio and your emotions perform the way you expected?
And if not, don't wait for more volatility to force your hand. A proactive mid-year review can make all the difference in the world.
Yep. And remember, you don't have to do this alone. And advisors such as us can help you reassess your risk, rebalance that portfolio, and help you plan strategically on how to move forward.
Of course. And so, with that being said, thank you for joining us. Keep pacing yourself, stay intentional, and let's finish the year stronger than what we started.
All right. Well, that'll wrap up this week's episode of Wealth Wisdom Workshop and for our Financials Forum. As always, I've got to take a pause real quick and say thank you to all the new subscribers who have joined us.
hmm
We are excited that we're picking up people almost daily now to watch the show, spread the news, spread information. It's great. We're getting this information out into the community. So welcome to those who've
1,000%.
joined us. Again, please write us if you have anything you want us to specifically talk about. We will be glad to do so. Also, I'll be speaking in Durham here coming up July 10th at the Transparency Workshop Summit. So we're talking about fee only and transparency in the world to better our client experience and client success. So again, we say thank you, thank you, thank you. Jeffrey and I are so excited to again present
Mhm.
this information to you. So again, until next time, we'll see you. Take care. Bye bye.